us today. Ilya, thank you for joining us. I'm excited about this conversation because Ilya has many insights to share, being a VC fund manager who are actually using AI in their investment thesis and in their investment process. They're also investing in some of the most disruptive AI companies around the world. And as we're going to hear from Ilya today, they have compiled one of the largest data sets on startup and VC activity um, that can give us some insights into the latest trends in investing and investing in AI. So, Ilya, maybe a quick introduction for the audience about Quantum Light and what you guys have built.
Sure. So we are a quantitative AI-driven venture capital and growth equity firm. We were founded by a guy called Nick Staronsky, who is the founder of Revolut and my business partner in this venture. We are a team of 25 engineers, data scientists, quant traders investing our fund. Uh, and what this means is that we use models, AI, rather than kind of traditional VC methods to find and invest in the companies for our portfolio.
What does it exactly mean you use AI? Can you be more specific and maybe for the non-technical, members of the audience, explain it a little bit more?
Sure. So we collect a vast amount of data. So we currently have, I think, just 700 million LinkedIn profiles. Each one has at least 6 positions. We partner with scores of data vendors. Then we aggregate this data, so we build pipelines to them, and then we engage in what's called data curation, which is a very common thing to do in quantitative investing. And so we build a kind of proprietary data set. And then we start to analyze to see what kind of factors could have predicted performance of companies over time, be that biographical features of the founders, who the other investors are, what kind of category the company is operating in, et cetera, et cetera. I think we analyzed over 300 different features to find about 40 which work. Now, when it comes to AI, how we're using that, so all of the text, there's a vast amount of text information about startups and venture-backed companies. And so we process that to find signals as well.
I'm trying to imagine this data set you're talking about. So LinkedIn makes sense to me. It's easy to imagine that. You've bought this data, and then what other inputs have you put into that data set?
Yeah, so the vendors we partner with, they range from kind of the more traditional ones, like kind of PitchBooks, Crunchbases, CBA Insights of this world, through to scrapers, like which can generate LinkedIn reviews, web traffic, and so on, through to manual labeling. So there's a huge industry of manual labelers in the AI space, where we can construct our own features.
Curious, how big is it?
Um, I mean, it's big data, so yeah, billions and billions of data points. So a lot of parallel kind of processing to evaluate it.
From my own experience, whenever I looked a company I'm personally either invested in or familiar with on these large data sets, I find a big degree of discrepancy with what the valuation is online and what the real valuation was. How do you deal with this type of discrepancy?
Yeah, data curation. You need to understand exactly how the data is generated, what to trust, what not to trust. You have to fill in blanks with models where you can. So, yeah, it is a tougher challenge than in public markets, but we certainly believe it's feasible. We have 20 years of LinkedIn data, for example. There is a huge industry of manual labeling that you can quickly create a data set. So we certainly think that in the future, most venture firms will be doing what we're doing.
So now you've built this data set. What's next? What's the next step?
Well, so it basically, we use a model, like an AI tool, that tells us whether to invest or not in the company, which is where the unique kind of angle happens. I mean, venture capitalists say that it's all about pattern recognition, and a systematic, model has perfect memory. It's not swayed by emotions. It knows everything, so it's certainly going to perform much better than a human. Certainly, our models suggest that we should be aiming for returns of well greater than 2x top decile or top 5% VC returns, so over 10x on the whole fund.
So let's say I'm a founder. I want to get money from your VC fund. do I apply or do you guys reach out? How does it work exactly?
Yeah, so we reach out. Yeah, so we're purely outbound business because we have a list of companies that our system thinks are the best, highest potential in the world. And so, yeah, we come to you and then you share some data with us. We update the model. And if it says yes, then we proceed to invest. So the process is super fast and very rigorous.
So it's more of a radar to pick up the most promising startups around the world. Then you reach out to those founders. What stages and how does access work? Because we all know like VC is a game of access as well.
Yeah, of course. So yeah, we reach out to founders. It's typically at Series B stage because if we're using a data-driven approach, there has to be good data about the company. There has to be a few turns of the headcount, for example. There need to be other investors in the company to understand, figure out the signal. I mean, on the side of access, I mean, my co-founder Nick Staronsky is one of the best entrepreneurs in the world. I have an entrepreneurial background, and we basically share the playbook of how to build the next Revolut. How to handle hiring, how to handle international expansion, how to do performance management. So you can just copy paste this and radically accelerate how you grow your company, and that's what gets us access in the deals.
I've heard from a lot of VC managers that say they're using AI. I wonder, A, how big is your fund? Are you just investing investor money or are you actually betting your own? It's not a question usually asked on stage about GP contributions, but I think with such an innovative investment strategy, one should ask if it's all LP money or is it your own money that you're putting at risk here?
Yeah, so we're a 200 million fund, and of that, 60 million is our own money. So we have like 30% GP contribution, which is probably one of the highest in the world for this type of venture.
So you're betting $60 million of your own money on a model you have built using a 24 person engineering team. Um, and as I understood from you before the session, some of these engineers, or most of them maybe, are in the region here.
Some of them are, yeah. I mean, we have a very high standard for hiring engineers. Like we hire people who like won international physics, maths Olympiads, data science competitions. We also have a very strong quant trader team that evaluate alphas.
And Ilya, you feel this will outperform the VC benchmarks?
Yeah, absolutely. So I think if you think about the VC, how VCs evaluate what to invest in, they usually weigh up a largish number of factors. So like who are the other investors in the business, what their track record has been, what's the category, and what sort of like amount of investor dollars it's attracting. What is the team like? What skills are on the team? Sort of what's the valuation increase over time? And they're trying to pattern match that to historical successes or failures, and trying to find sort of situations that are similar. And I think there's no good reason why a machine shouldn't do this better and faster, and also protect against these cases where something is really overhyped. One thing we learned actually is that the degree to which a deal is oversubscribed has nothing to do with the onward prospects of the company. So it's actually like hot deals or not, they have about equal chance of success, which is a surprising result, right? So, and generally speaking, in VC, there's never a case that oh, it's a great company, strong founder team, huge growth, amazing category, exceptional investors, and they're willing to give it away for free. There's always some risk in any investment, and having a system really helps you really weigh up those factors in a way more precise way than a human possibly could.
So, wondering, for example, a company like FTX, amazing investors, Sequoia, one of the best names in the world, writing a $375 million check. For me, this is like a great signal. Did you test it through and what would your model say?
Yeah, so what knocks out FTX, why we would not invest in it, is it's actually the increase in valuation between Series A and Series B rounds, which is an important feature. So a kind of sustainable pattern of increase in valuation is, let's say, 3 to 5 times every sort of 3.5 to 4 years. Now, I think with some of those stories, FTX, there were other. I mean, FTX turned out to be a fraud, but like Clubhouse, and I mean, I can find more. But really, there was a huge gap up in price. So our system would downgrade that.
What have been some counterintuitive insights you sort of learned from the system so far?
Counterintuitive. I mean, yeah, there's a bunch of ins. I would say, really, the interesting thing is how it's really a combination of factors that can be really different in terms of finding the best companies. I mean, we also occasionally find like curious factors. So, for example, founder features. We tested whether STEM education or not, expat or not, age. We tested whether even dropout from college predicts performance, and the answer to that is that it only works in combination with top university. So if you're going to drop out, you better drop out of Harvard. So yeah, if you're in a kind of mediocre university, by God, you should finish the degree.
You you have maybe you can tell us also a little bit about where you are in this journey. Did you start deploying? How did the first investments go, if you did?
Yeah, absolutely. So we started deploying in about June this year. So we already are like about 20% deployed. So our thesis on access is clearly working. Like we're able to get in virtually every deal that we look at. We invest a lot in AI as well. We have a unique understanding of AI where our thesis is to find companies with application space with unique data sets, very strong teams that are about to inflect, and we were able to find those in the medical space, for example. So we're investors in a company called Red AI and DeepScribe, which are sort of emerging as leaders in all kind of medical note transcription in the US. We invest in legal tech, AI companies, and that's just to name a few.
So my final question for you, for the investors and the founders in the room, you seem to be purely outbound. Your model is identifying these winners, and then you're reaching out to them and you're getting that access. Do you feel that within 5 or 10 years, this is how VC is going to operate? And for the founders, they should maybe prepare for a world where don't call us, we will call you?
Yeah, I think it's a big market, so you can't say that everyone will operate this way. I think where we are right now is like hedge funds were in the 70s. If you remember, in the 70s, the hedge funds, they were driven by research. So people were reading annual reports and creating a model and analyzing fundamental data. Then the advent of quant investing really came, and some of the quant hedge funds have dramatically outperformed these kind of fundamental strategies. So some produced the best returns in the history of returns. In VC, we're a bit still like hedge funds in the 70s, and we're still using kind of partial information and research type reasoning to find companies. For sure, quants will be a large share of the market in the next 10 years. No doubt about that, in my view.
Ilya, thank you so much for sharing these insights with us, and of course, best of luck with the fund.
Thank you.
Thank you.